Hi guys, I'm back. And before I start with a full-fledged set of sums on PPE, that is property, plant and equipment, I thought I would want to make one video on IND AS 20, which is basically accounting for government grants and disclosure of government assistance. It is an important accounting standard in the whole non-current asset series. The first one was IND AS 16, which was property, plant and equipment, and this one is IND AS 20. Now, I have received several requests for getting IFRS 16 or IND AS 16 done, and we'll be starting with that in the next week. So, today I want to spend time on discussing IND AS 20, which is accounting for government grants and disclosure of government assistance. Now, the word government grant is basically some sort of a help from the government. So is government assistance. Both of these are additional support that the government is providing you. But there is one fundamental difference between the two. The fact that government grants involve transfer of resources to an entity in return for past or future compliance of certain conditions. For example, if I am a farmer and the government wants to encourage sericulture. What is sericulture? Silkworm farming. If the government wants to encourage that, the government says that, listen, if you start sericulture in your farm, if you do silkworm farming, and if that works successfully, you start silkworm farming, we will help you get the right price for your commodity. We'll help you to get the right price for your goods by giving you easy access to certain e-marketing platforms. That is government assistance. It is action by the government to provide certain economic benefits. There is no transfer of resources happening here. But if the government says that you set up a plant in interior Jharkhand and if you set up a plant in interior Jharkhand and you set up a factory, for the first two machines that you purchase, we will give you 50% of the purchase cost of those machines. What we will do is we will give you 50% of the purchase cost of these machines. Now the government, if you have purchased a machine worth 10,000, government is going to pay you 50% of the machine cost. So if the machine is for 10,000, the government will give you 5,000. So there is transfer of resources that has happened here. Hence, that is a government grant. The first scenario where if you indulge in sericulture, the government gives you easy access to certain e-markets for sale of your products. That is government assistance. Or if it helps you in social media marketing, that would become a part of government assistance because there is no transfer of economic resources. You are only getting economic benefits by some action of the government. So, India is 20. The first part that we'll be focusing on is government grants. Now, government grants are basically, as we saw, transfer of resources to an entity in return for past or future compliance of certain conditions. When will the government give you 50% of the asset cost? If you set up a manufacturing plant in interior Jharkhand. So, there are certain conditions that have to be fulfilled first before the government gives you the grant. The government grants should not be recognized until the conditions for receipt of the grant have been fulfilled and there is reasonable assurance that the grant will be received. Reasonable assurance means a very high level of assurance. It does not necessarily mean 100% or absolute assurance. What it means is there is a high level of assurance that the grant money that has been promised to you will be received. Now, the government grant, again, should not be recognized. I'll repeat, until the conditions connected with the grant have been fulfilled and there is reasonable assurance that the grant will be received. The reasonable assurance means high level of assurance, but not absolute assurance. Now, there are two types of grants. Grants which are received for meeting day-to-day expenses and grants which are received for purchase of capital assets or non-current assets. The grants which are received for meeting day-to-day expenses, this is help, monetary help that you are receiving from the government for day-to-day expenses. How do you account for it? There are two options. Option one, the amount of grant that you have received, you should credit it to profit and loss account. The expense is on the debit side of P&L, the income is on the credit side of P&L. If you don't want to apply this approach, what you can also do is you can deduct the amount of grant from the total expenditure incurred and show only the net amount in the outer column of P&L. Say, for example, the government has told that if you employ 100 workers in your factory, we will pay you 80% of the wages that you will be paying these workers. Say that I have paid 10,000 to these workers, government is giving me 8,000. So that 8,000 can be shown as a subtraction from the 10,000 and show only 2,000 in the outer column. Capital grant is grant given for purchase of an item of property, plant and equipment. This is basically for purchase of capital assets or non-current assets. Now here you have two methods again. Method 1 is known as the deferred income method. Method 2 allows you to deduct the amount of grant from the asset cost. Now, the word deferred income means income that has been pushed into the future. Once we understand the deferred income method, I'm going to do its comparison with the conceptual framework in a separate video. Right now, let us understand the accounting treatment. In method 1, what you do is when a grant is received, you credit the amount of grant to an account called the deferred income grant account. Now, what are the accounting entries? When you purchase the asset, you record the entry non-current asset to cash. So a person called Srinivasan, for example, he purchased a bike for 10 lakh rupees. Okay. The accounting entry is bike account debit to bank account. And now the government is giving him a grant of 5 lakh. What you do is when you receive the amount of grant, debit bank, credit grant, deferred income. 10 lakh is debited to bike, 5 lakh is credited to grant. Now pay attention. Assume that the useful life of the bike is 10 years. Now, if the useful life of the bike is 10 years, the cost of the bike is going to be debited to P&L in the form of depreciation over 10 years. So 10 lakh upon 10 is the amount of, if we are using the straight line method of depreciation, we will be debiting 1/10 of the cost to the profit and loss account every year. So we'll record the entry depreciation account debit to accumulated depreciation, and 1 lakh ka expense goes to profit and loss account every year. Now you have credited an account called the deferred income government grant account. The useful life of the asset is 10 years. This grant was received for the purchase of that asset. We are applying simple matching principle. Expense and the income earned because of that expense should be shown in the same P&L. If 1/10 of the asset cost is getting debited to P&L, then 1/10 of the amount of deferred income grant should also be credited to P&L. So what you do is you debit grant, that is deferred income account, and you credit profit and loss account. So there is a debit of 1 lakh in P&L, there is a credit of 50,000 in P&L. The net impact on P&L is only 50,000 debit. And this deferred income should be shown under non-current liabilities. At the end of year 1, balance in deferred income is 4 lakh 50. How 4 lakh 50? 5 lakh minus 50,000. Now you are standing at the end of year 1. You have transferred the amount from grant, that is deferred income, to profit and loss account. Now, how much of this deferred income will get transferred to P&L in the next 12 months? 4,50,000 is the balance in deferred income account. 50,000 is going to get credited to P&L in the next 12 months. So 50,000 of the deferred income should be shown as a current liability. The remaining amount should be shown as a non-current liability. That is the presentation aspect. And the net hit to P&L, 1 lakh debit to P&L on account of depreciation, 50,000 credit to P&L on account of the government grant. Net debit to P&L is 50. All I'm doing is I'm applying the matching concept. The second approach that is allowed is you can adjust the amount of grant against asset cost. So what you do is you record the asset at its original cost. You record the entry non-current asset account debit to bank. Then you record the entry for receipt of grant, bank account debit to grant. This entry is the same as the previous one. And then you adjust the grant amount in the amount of non-current asset. Grant account ko debit karo, non-current asset ko credit karo. Grant account debit to non-current asset 5 lakh. What is the balance in your asset? Asset mein what is the balance left? 5 lakh only. 1 lakh cost 10 lakh cost minus 5 lakh grant. 5 lakh is the cost remaining in the asset account after the adjustment. Now, again, when you have to depreciate, what you are going to do is 5 lakh upon 10, 50,000 will be the depreciation in P&L. So net debit to P&L remains the same regardless of the method of recording government grant. If you use the adjustment against cost method, you record the entry for receipt of grant in the normal way, and then what you do is you adjust the amount of grant against the asset cost, grant account debit to asset account, and then you depreciate as usual. If you are using the deferred income method, record the asset at cost by recording an entry non-current asset to bank, start depreciating the asset over its useful life. Whatever is the amount of government grant received, record a regular entry bank account debit to government grant deferred income account, and then over the entire useful life of the asset, keep on writing back this amount of grant to the profit and loss account, debit the government grant and credit P&L. This is the These are the two approaches to recording the accounting entry for government grant of non-current or capital assets, which we call capital grants. And for assets received free of cost, assets which are gifted or given by the government without taking any consideration from you, these assets should be shown at a nominal value in the financial statements. By nominal value, I mean it could be a value of 1,000, 1,500, whatever. The number is not important. What is important is that when you are preparing notes to accounts or disclosure, their detailed information has to be given about which assets were received free of cost and from whom they were received, and what is the name of the body that has given you this particular asset free of cost. So right now what we have seen is how to account for government grants. We haven't spoken about government assistance yet, apart from the basic definition. We looked at the two entries or two approaches for recording a revenue grant. We also looked at the two approaches for recording a capital grant. Okay. In the next session, what we are going to do is we are going to discuss the repayment of government grants, how the accounting has to be done. I'll be giving you a table and a set of steps. We'll also understand the disclosures and the point about government assistance. Questions. ICAI module questions on property, plant and equipment will be out very soon, along with detailed lectures on IND AS 116. Watch out this space for more. Please subscribe to my channel and hit the like button. Do let me know what specific accounting standard or any concept that you want to study, and I promise you I will release that within 72 hours. Thank you so much.